Okay, please come to IFRS 5, non-current asset held for sale and discontinued operation. IFRS 5, non-current asset held for sale and discontinued operation. So the standard is quite simple but quite important also, because there may be many non-current assets in the balance sheet which are held for sale as per the standard, and since these are held for sale, this means these are no longer non-current, because the management wants to recognize them, realize them within say 12 months. So even though these are non-current asset, but their classification would change to current asset in the standard. Plus the standard requires you to give disclosure about discontinued operation. That means you have to disclose the profit or loss from discontinued operation separately. Question for you: why we need to give information about discontinued operation? So that the investor will understand that during this year, out of so much profit, this portion of the profit or loss is due to discontinued operation. In the future, this profit or loss may or may not occur. Okay. Similarly, cash flow statement will give you information about cash flow from discontinuing operation, which means in future this cash flow will not occur. Knowingly, after knowing this, the investor will be able to take a better decision. So that is all about the standard. What are non-current asset? Are those which do not meet the definition of current asset as per IAS 1. Okay. What is current asset, which we will discuss little later? This is the balance sheet, or what we will call SOFP, statement of financial position. Asset side has two items: non-current asset and current asset. The standard is not applicable, as you can understand from the name, current asset, but sometimes current asset may be a part of a disposal group. So that time we'll have a little bit discussion about current asset. So it talks about these non-current asset, not all, only those which are held for sale. These are already current. In the standard, those non-current asset which will be held for sale, the classification would change to current asset, because they are expected to be sold within 12 months from the date of classification. Is it right? So we have to identify in the standard what are the conditions required for an asset or a disposal group to be called held for sale. Okay. How will you measure these assets? Are you going to follow the normal rules, or there are separate rules for measurement? Okay. Then what are the presentation requirement in this standard? What are the disclosure requirement in this standard? Then the standard also discusses about discontinued operation. The standard lays down the criteria to be met for classification of such asset as held for sale. So first few minutes we will understand when will you call a non-current asset as held for sale. Okay. What are the conditions required? And then next paragraph, next few lines, we'll discuss about the measurement and disclosure and presentation part. So standard is very simple. This standard deals with items classified as non-current asset held for sale. It should be presented separately in the financial statement. So now if you have a non-current asset held for sale, it will be treated as a separate, it will be presented as a separate item in the list of current asset. Similarly, if there is any liability also associated with this, it will be presented separately, so that the user of financial statement will understand that these are non-current asset item but held for sale. Okay, so as to distinguish this from other elements of financial information in the financial statement. Now there is a long list of definition. First we will go through some key definition and then we will start the standard. These terms have been used, some of these terms have been used in other standards also. For example, cash generating unit, it is popularly called CGU. Which standard talks about the definition of CGU? IS 36, impairment. Okay. Now what is a CGU? It is the smallest identifiable group of asset that generates cash inflow that are largely independent of the cash inflow from other assets or group of asset. This is suppose one asset. In order to check this asset for impairment testing, I need two numbers. I need recoverable amount, I need carrying amount. In order to calculate recoverable amount, I need two information. Which two information? Value in use, FVLCTS, fair value less cost to sell. Okay. Now fair value less cost to sell may be found out. But what is difficult to calculate for an individual asset? Value in use, that is the present value of future cash flow. Asset may not generate independent cash flow. So we'll go to that group of asset which generates independent cash flow, whose value in use, whose fair value less cost to sell can be calculated separately. Is it right? So this smallest group of asset which generates independent cash flow is called cash generating unit. So in this classroom, this computer may not be a CGU, but the whole classroom will become the CGU because this generates independent cash flow. Now next is component of an entity. What do you mean by component? They have used a very broader term called component. This word will be used in connection with discontinued operation. The purpose of this definition is it will be used in the definition of discontinued operation. What can be a component? Any operation and cash flow that can be clearly distinguished operationally and for financial reporting purpose from the rest of the entity. So it is anything in a business whose cash flows, profit and loss, asset and liabilities can be distinguished separately from the rest of the asset. So you should be able to identify following items separately for this component. Example, a component can be an asset only. A component can be a group of asset. A component can be, say, a factory or say a business unit. Say it can be a subsidiary. It can be a location. So anything whose asset, liability, income, expense and cash flows can be distinguished from the rest of the entity. The reason why they have defined like this, they will ask you to give separate disclosure about a discontinued operation. A separate disclosure is possible only if you can calculate their asset, liability, revenue, expense and cash flow separately. If you can't, then you can't apply the standard. Now next is cost to sell. Cost to sell is easy term. It is an incremental cost directly attributable to the disposal of an asset or a disposal group. But it will not include, or you can say it will exclude, any finance cost like interest and income tax expense. Any example? Cost to sell, brokerage, commission, transportation, loading and unloading, handling. Okay. Now, when will you apply this term cost to sell in this standard? While calculating fair value less cost to sell. That means the standard says non-current asset held for sale will be valued at lower of carrying amount and fair value less cost to sell. So that time this cost to sell what means incremental cost required for disposal of an asset or a disposal group. Current asset I am not defining again because we have already discussed in many other chapters. Let us come to discontinued operation. This is important for the purpose of disclosures. The standard says a discontinued operation is a component of an entity. Component means whose cash flow, income, expense, asset, liability can be distinguished separately from the rest of the entity. That the entity has been, that either has been disposed of, it may have been disposed of, sold, money received or receivable, or a component of the entity that is classified as held for sale. Means the management is going to sell it. Okay. So it may be either, you can say in simple words, sold or to be sold. If it is sold, then also it is a discontinued operation. And if the management has decided to sell, then also it will be a discontinued operation. Why to wait for tomorrow? Now you know that it is going to be sold. So from this year only, you start giving information about this operation separately. Now what are the features of a discontinued operation? First is it should be a component of an entity that has been sold or is about to be sold, held for sale. Second is it represents a separate major line of business. Now this is a little subjective term. Separate major line of business. They have not defined further what is a separate major line of business. That means it should generate significant amount of revenue. Its assets should continue a significant amount of the total asset of the group, etc. Normally, but not necessarily, if the revenue or profit or loss or assets of this operation is 10% or more of the revenue, 10% more of the profit or 10% or more of the asset, then prima facie you can assume it is a separate major line of business or geographical area of operation. For some entity, product is important, that is business, and for some entity the location is important. For some entity the location is important. So therefore, depending upon what is that business, whether it is more product driven or customer driven, it can be separate major line of business or geographical location. 10% is the normal situation, but suppose it is 9%, still you can call it as a major line of business. So some degree of subjectivity is involved here in deciding whether it's a major line of business or not. That is a part of a single coordinated plan to dispose of a separate major line of business or geographical area of operation. Second thing is that management must dispose of as a single coordinated plan. Now this is a cement factory of JP Cement. Now they want to sell this entire cement factory with all its machine, equipment, land, building, furniture, data, inventory. Then it will be called as a discontinued operation. It is not that they should sell this plant separately to one party, land to one party, one inventory one by one to another party. Then this may not be fulfilling this definition. Okay. And the third is it can be a subsidiary also. In case if you are preparing the consolidated financial statement, then a subsidiary acquired exclusively with a view to resale, then that will also be called a discontinued operation. Okay. And then the disclosure requirement with respect to such subsidiary will apply in CFS. The purpose of discontinued operation in the standard is to let the user understand how much is the profit or loss for the year you have earned or incurred on discontinued operation, how much cash flows have been generated by the discontinued operation, how much asset or liability is related to discontinued operation. Okay. Because once it is discontinued, this income, expense, cash flow, asset, liability will not be there. Which may be a good news also, which may be a bad news also. If it is a loss making component, then the discontinuation is a good news for the investors, because it is not going to suck your money anymore now. Okay, lose your money anymore. But if it is a profit making unit and that you are going to discontinue, then it may be a bad news for the investors. Is it right? Now, disposal group. Disposal group means a group of asset and which you are going to sell together. A simple example can be this factory building or this factory. This is a factory you want to sell. So it factory may have land, this building, and it may have equipments, furniture, plus you may have some liabilities also, like loan taken for this factory. Okay. A group of asset to be disposed of by sale or otherwise, means exchange transaction. Otherwise can be like exchange. Together as a group in a single transaction. That means the management does not want to sell it piecemeal, but rather they want to sell the whole group of asset together only. And sometimes there may be liabilities also, and liabilities directly associated with those assets. For example, a loan taken for the purpose of this factory building, that will also be transferred in the transaction. So normally in such cases, what the negotiation is, I am going to transfer the whole factory along with the liabilities also. So in that case, the disposal group will include the liabilities also, that will be transferred in the transaction. The term group also includes goodwill. Underline. In one or two questions we are going to discuss, their goodwill is also given. So this particular group of asset may include a goodwill acquired in a business combination if the group is a cash generating unit. If this group of asset is a cash generating unit, we have discussed cash generating unit, which generates independent cash flow. And this CGU was acquired in a business combination. So therefore you might have paid for goodwill also. And it meets the definition of disposal group. It may not meet the definition of discontinued operation because it may not be a major line of business. A company has 100 factories. One of them you are willing to or planning to dispose of. So it may be a disposal group but may not be a discontinued operation. And it is a CGU to which goodwill was allocated as per IS 36, or if it is an operation within such a CGU. So disposal group can be a CGU or an operation within a CGU also, or a group of CGU also. Group of CGU, CGU, an operation within the CGU. But there is no major role of goodwill in this chapter, except that in case if you have to provide impairment in a CGU or a disposal group, the first item that will be impaired will be the goodwill. Next is fair value, already discussed in previous chapter. Next is firm purchase commitment, an agreement with an unrelated party binding on both the parties, usually legally enforceable. That is why firm purchase, both parties are legally bound to honor the contract, which specify all significant terms including the price and timing of the transaction, and includes a disincentive for non-performance. That is a penalty clause in case if you violate, that is sufficiently large to make performance highly probable. The purpose of this is that in case if the company has entered into a firm purchase commitment to sell an asset or a disposal group or a discontinued operation, it shows the commitment of the management to dispose that unit. So that is the relevance of this. And what do you mean by probable? Probable means more likely than not. Now what do you mean by more likely than not? Probability is more than 50%. This word probable will be used in the standard many times. Okay, so probable. And what is highly probable? Significantly more likely than probable. But the standard does not give you any benchmark left to your judgment. That means there is a high degree of possibility that this event will happen. You will come to the class is probable. I will come to the class is highly probable. Understood? That is the difference between probable and highly probable. Next is value in use. Discussed in IAS 36 impairment. Present value of estimated future cash flow expected to arise from the continuing use of the asset and from its disposal at the end of its useful life. Similarly, recoverable amount has been defined in IAS 36 impairment. Higher of the two. Assets fair value less cost to sell. Now you will find the relevance of all the definition. Fair value has been defined, cost to sell has been defined, or its value in use. And what is a non-current asset? Asset which is not a current asset is a non-current asset, defined in IAS 1 also. Okay. So all discussion on definition we have. Now come to the scope paragraph. The standard is applicable to those non-current asset or disposal group or discontinued operation which are held for sale. Is it right? So all non-current asset and disposal group, when classified as held for sale, shall be measured, means the valuation part, presentation, and disclosed as per this IFRS. But there are exceptions. Okay. What are these 6 or 7 exceptions? Deferred taxes, IAS 12 income tax, asset arising from employee benefit, IAS 19 employee benefit, financial asset under IFRS 9, financial instrument, non-current asset that are measured at fair value less cost to sell in accordance with IAS 41. This is one sentence. IAS 41, agriculture. Group of contract within the scope of IFRS 17, that is insurance contract, and non-current asset that are accounted for in accordance with the fair value model in IAS 40, that is investment, property. Okay. What about non-current asset, which is measured at cost model in IS 40? IS 40 has two model, cost model and fair value model. Exception applies to fair value model. But if it is a cost model, then you are going to apply this standard. And cost model is rare. But still, if it is there, you can apply this standard. These assets mentioned here, these 7 items, will be required to be measured under the respective standards. When non-current asset and disposal group meet the criteria to be classified as held for sale, underline, it will get reclassified as current asset. So from non-current, they will move to current asset, presentation requirement number 1, and in current asset also they will be presented as a separate item, so that the user have a better idea which assets are going to be sold. Next question is, when will an entity classify a non-current asset as a disposal group or held for sale? What is the triggering event? That yes, if this happens, I am going to classify it as non-current asset held for sale. Now in the balance sheet we have this property, plant, equipment. It has a carrying amount. How am I going to recover this carrying amount? There are two ways I can recover the carrying amount, either by using it or by selling it. Check the intention of the management. How are they going to recover the carrying amount of this asset? If the carrying amount of this asset will be principally recovered by sale rather than through continuing use, then this is an asset or a disposal group held for sale. Now what do you mean by principally recovered? That means their company wants to sell it. Management has taken a decision. They are actively looking for a buyer. They are willing to sell this asset at the market value today, not a very high expectation. Whatever is the ongoing market price for this, they are willing to sell, and they are not going to change their plan of sale also. But till it is sold, can it be used till it is sold? Yes. I have a factory. I want to sell it, and I am actively looking for a buyer. So does it mean that I will shut down my factory? No. Factory may be used as usual, but we are also in the process of actively looking for a buyer. So the moment I get a buyer, I'll stop using and I'm going to sell it. Okay. Do not have a wrong understanding that once it is classified as held for sale, it won't be used at all. My computer, this computer where I write every day, is held for sale. I have put a notice on the notice board, computer for sale, contact office. But then nobody turned up today. So I'm still using it. Tomorrow again I will put that same notice. So sometime you may use it, but my main motive now to recover the carrying amount is through sale rather than continuing use. Okay. So in between some questions will also come to test you, to check whether you are awake or not. Sun Limited is a retailer of takeaway food like burger, pizzas. It decided to sell one of its outlets located in Chandni Chowk in Delhi. The company will continue to run 200 other outlets in New Delhi. So there are 200 outlets. One of them is sold. One of them out of 200. How much percentage is that? 1 by 200? Not even 0.5%. Is it right? In terms of number, it is just 0.5%. All IFRS 5 criteria for held for sale classification were met on 1st October. The outlet will be sold in June. Management believes that this outlet is a discontinued operation and wants to present the result of the outlet as a discontinued operation. Analyze. Now, what is your view? Should we disclose it as a disposal group held for sale, or should it be disclosed as a discontinued operation? Or asset held for sale? In the standard, 3 items are there. Asset means individual item, group of asset, and the third level is discontinued operation. So this company wants to disclose it as a discontinued operation. They have not given information about the revenue, profit, asset dedicated, but they have given you that it is 1 out of 200, which in percentage term will be 0.5%. So therefore we will not call it as a discontinued operation. Rather, it will be more appropriate to call it as a disposal group. So write the answer. The Chandni Chowk outlet is a disposal group. Is a disposal group. It is not a discontinued operation. It is not a discontinued operation as it is only one outlet. As it is only one outlet. It is not a major line of business or geographical area. It is not a major line of business or geographical area. Nor a subsidiary acquired with a view to resale. Nor a subsidiary acquired with a view to resale. Nor a subsidiary acquired with a view to resale. Now next is criteria to be met. Now this 5 or 6 conditions you have to remember for writing many answers. For a theory question you have to apply this line by line carefully, and then you will be able to judge whether it is held for sale. First basic principle is that its carrying amount will be recovered principally through sale and not from continued use. Now how do you know that it will be principally recovered through sale? Next criteria, the asset or disposal group should be available for sale in its present condition. Underline, subject only to terms that are usual and customary for sale of such asset. Subject only to terms that are usual and customary for sale of such asset. This classroom is available for sale, but my batch is going on. I asked the buyer, wait for 3 months. First let this GFRS batch get over, and then you can acquire it. So this is customary in such business, especially the teaching business or teaching profession. Now it has become business, that in case if some batch is going on, normally the buyer would allow that batch should get over and then the handover can be done. Is it right? So in that case we will say that yes, this condition is satisfied. But if I say no, first we are going to repair, maintain and renovate, and then we are going to sell it to you, that means it is not available for sale in the present condition. So sometimes there may be some condition they will give you, but if you think these are usual and customary for sale, then assume that this first condition is satisfied. Second is sale should be highly probable. Now, how to check whether sale is highly probable? There are some conditions they have mentioned. 4 condition checks. Sale is highly probable. Entity's management should have approved the plan to sell the asset. So, whosoever is the necessary authorized party in the entity, either board of directors, CEO, CFO, or any appropriate level of management who is authorized, has approved the plan to sell the asset. Second, active steps have been initiated to locate the buyer. Whatever in that particular business or that asset requires you to find the buyer, you've started doing that. Like you may have given a newspaper ad, you may have appointed broker, commission agents, and to complete the sale at a price, underline, reasonable in relation to its current fair value. One question will come below where the management wants to sell it but at a higher than the current fair value. Then you have not satisfied this condition. You want to sell this building for 10 crore, but market price is 5 crore only. So assuming other conditions are satisfied, still it will not be held for sale because management is not willing to sell it at a reasonable price in relation to current fair value. And one more condition, the sale is expected to be effected within 1 year. From which date? Underline, from the date of classification, not from the date of the statement of financial position, reporting date. Date of classification, 1 year. And the last condition to check whether it is highly probable, the plan is unlikely to be withdrawn and is not likely to undergo significant change. These 4 points which you read just now, these are the test to check whether the sale is highly probable or not. An appropriate level of management has approved the plan. Active steps have been initiated to locate the buyer. Expected to be complete within 1 year, and the plan is unlikely to be withdrawn. Welcome. Now you are an asset held for sale. But in some jurisdiction, in order to sell some asset or a disposal group, you may require the shareholders' approval also. So in that case, condition number 5 will also apply. The probability of shareholders' approval, if required in the jurisdiction, should be considered as a part of the assessment of whether the sale is highly probable. That means if you think that the shareholders are easily going to approve the proposal, then probable. But if you think shareholders' approval is not easy to come, then it is not highly probable. Okay. So when you read this entire definition, some degree of subjectivity is little bit involved here. For example, the sale is expected to be effected within 1 year. Now that requires judgment. Then approval of the shareholder will require some degree of judgment. Okay, now we'll take some easy problems. Question number 2. The board of directors of a company has decided to sell a line of business. Accordingly, an action plan has been prepared. Also, the necessary resolution has been initiated for approval of the shareholder. Are the assets of the business line available for immediate sale? When should the company classify the group of asset as a disposal group? Write the answer. When should the company classify the group of asset as a disposal group? After the approval of the shareholder, because also necessary resolution has been initiated for approval of the shareholder. So the answer of this question would be, even though the asset is available for sale in the immediate condition, but one has to see what is the probability of getting the shareholder's approval. the shareholders approval is highly probable, then you can start applying right now, otherwise wait till the approval. Okay. So write the answer like this. The asset of the business line are available for immediate sale. The asset of the business line are available for immediate sale at their present condition. At their present conditions. Are available for sale at their present conditions. But whether it is held for sale or not, for that read the second line. Based on the controlling structure. Based on the controlling structure of the company. Based on the controlling structure of the company. It is to be evaluated. It is to be evaluated whether the board's decision would be approved by the shareholders. Whether the board's decision would be approved by the shareholders. And there exists uncertainty of approval of the board's decision. There exists uncertainty of the approval of the board's decision. Okay. In case the shareholders' approval is required, one more line. Use short fonts. In case the shareholders' approval is required, the assets of the concerned business line, is classified as disposal group. On approval of the decision, to sell by the shareholders. On approval of the decision to sell by the shareholders. This is how one should present the answer. You will write yes, no. Done? Read the next question, those who have done. But before that, what I'll do, there is a paragraph above question number 2 that we will read. In your notes, come to paragraph above question number 2. If the above criteria are met, means those 5 conditions of highly probable sale, if the above criteria are met after the reporting period, the entity shall not classify as a non-current asset or disposal group as held for sale in those financial statements when issued. Okay. So if the sale is highly probable that condition get fulfilled after the reporting date, then it is a non-adjusting event. However, when those criteria are met after the reporting period, but before the authorization of the financial statement, the entity shall disclose the information in the notes. So it is a non-adjusting event. If material, they are going to be disclosed in the notes. Okay, now you try next question number 4. An entity is committed to a plan of selling headquarter building, very good, and has appointed a real estate dealer to find a buyer. The entity intends to vacate the building once the construction of a new building is completed, which is targeted to be within 1 year of the plan to sell. Does it satisfy that condition that the asset is available for immediate sale? No. Why? So there is a condition attached there. The entity intends to vacate the building once the construction of a new building is completed. So will the potential buyer wait for a year? What is the normal custom in this business? Will you wait? Suppose you have bought the building and the company says you wait for a year. No, will not wait. What will say? Take the money, give the building? So the answer is no. So the answer for this question is no. The asset is available for sale, but it is not available for immediate sale. It is subject to completion of construction of a building. It is subject to completion of construction of a new building. Okay. Now you try the next question. I will not show you the question because the answer is also appearing. What is the next question? E limited. Oh, it's a different one. Same question. It is there. Okay, question number 4. So read from the book. An entity, question number 4, I am reading from the book. An entity is committed to a plan of selling a manufacturing facility and is considering an accounting proposal of classifying the assets and liabilities of the facility as a disposal group. There is some pending order. It wishes to immediately sell the factory with a clause that backlog orders will be completed under the guidance of the seller. Does it satisfy the condition that the asset is available for immediate sale? So probably in such business, it is customary that the buyer will allow you to complete your backlog orders. If the answer is yes to that question, then you can say that the asset is available for immediate sale. So write the answer of this question. Yes, the asset is available for immediate sale in its present condition. The asset is available for sale available for immediate sale in its present condition. Subject to terms usual and customary for such sale. Subject to terms usual and customary for such sale. One more line write down. Arrangement for completion of a pending order is usual. Arrangement for completion of a pending order is usual and customary when a business is proposed to be sold as a going concern. When a business is proposed to be sold as a going concern. So this can be treated as customary, usual terms. But selling a building and asking the buyer to wait for 1 year till I complete my construction of new building is not a usual term and condition. Okay, try one more question. Number 5. E Limited buys a building in an auction with an intent to resell. The management has a plan to renovate the property and install lift before selling, which will be completed within a short period of 3 months. Is it possible to classify the property as held for sale? No. Why? It is not available for sale in its present condition. So write down. The answer is no. The asset is not available for sale in its present condition. When the asset is renovated, as per the plan of the management and put on sale, then only it can be classified as held for sale. Then only it can be classified as held for sale. Okay, try the next one. E Limited acquired. Try the next one. E Limited acquired all the assets of F Limited, including a building. It plans to sell the building immediately after getting the possession. The management expects to get the possession of the building within a prescribed short period of 3 months and is confident to complete the sale within a year. Is it possible to classify the property as held for sale? What is your answer? No. Why? Possession is pending. When will you get the possession? Is 3 months a very long period of time? So first write the answer yes. The asset is available for sale in its present condition. It is available for sale. You don't have to do anything. Other criteria stated in IFRS 5 can be satisfied within a period of 3 months. Can be satisfied within a period of 3 months. Therefore, the building can be classified as held for sale. Objection. You can start looking for the buyer. And in case of asset like a building, usually 3 months is not a very big number of months. People can wait. Written. Previous problem was you wanted to do renovation, installation of lift. But here you don't have to do it. It is in a available for sale condition. Next question. Solve yourself. True or false? Held for sale or not held for sale? Not. Why? Renovation. It is not available for sale in its current condition. So your answer is right. The property cannot be classified as held for sale because this time it is subject to renovation. The property cannot be classified as held for sale at the reporting date. As it is not available for sale in its present condition. Although the renovations are expected to be completed, within a short span of 2 months, this fact is not relevant for classification. This fact is not relevant for classification. Okay, let us continue with this wonderful chapter, IFRS 5. One more line, write down in the previous answer about disclosure. This line copy in the previous answer. If the PP meets the criteria for held for sale, by January 31st, 2020x2, by January 31st, 20x2, that is 2 months from November 30, that is 2 months from November 30, 20x1, and the accounts are not authorized by that date, necessary disclosures need to be given in the financial statement. Necessary disclosures needs to be given in the financial statement. FS, financial statement. Done. Okay, now you will try one more question. Question number, I think 8 now. Is it right? First, we'll read the question from the book. On March 1, 20x1, entity R decided to sell one of its factories. An agent is appointed and the factory is actively marketed. Very good. On 31st March 20x1, it is expected that the factory will be sold by February 28, 20x2. Again, very good. So these basic conditions are getting satisfied. However, in May 20x1, the market price of the factory deteriorated. Entity R believed that the market will recover and thus, underline in your notes, thus did not reduce the price of the factory. Company's accounts are authorized for issue on 26 June 20x1. Should the factory be shown as held for sale as on 31st March 20x1? Question number 8, read carefully. Focus on the dates. Till 31st March 20x1. You have to see the category on 31st March 20x1. Till 31st March 20x1, is it held for sale or not? No. When did the market condition deteriorated? In May. That means post balance sheet. So now the question is whether it is adjusting event or a non-adjusting event. Till 31st March, it is companies actively looking for the buyer. Factory is available for sale. Company expects to complete the sale within 12 months. There is no change of plan. But after the reporting date and before the financial statement are authorized for issue, the market conditions have deteriorated. Price have gone down, but the management is not reducing the price of the factory. It is going to sell the factory at the higher price. That is what it says. So you are preparing the financial report on 31st March 20x1. What would be the classification? Held for sale or non-current asset only? Both answers we are getting. One person is saying held for sale. One person is saying not held for sale. The correct answer would be held for sale. And whatever has happened post balance sheet before it is authorization is a non-adjusting event. So write down the answer. In this example, the factory ceases to meet the definition of held for sale post the reporting date, not on the reporting date, post the reporting date. Why? But before the financial statements are authorized for issue, as it is not actively marketed at the reasonable price. But since the market conditions deteriorated post the reporting date, the asset will be classified as held for sale. As at 31st March 20x1. So this is a non-adjusting event. After that long discussion on different questions, now let us read some more provisions, and again question answer session will start. Okay. This standard has one more provision called non-current asset or disposal group as held for distribution to owners. Non-current asset or disposal group as held for distribution to owners. Now instead of selling it, it will be distributed to the owner. So this is a non-current asset. If it is held for distribution to owners, then also this standard is applicable, and it will be more or less accounted in the same manner like non-current asset held for sale. The only thing is that it will be again presented separately in such a manner that we will be able to know that this non-current asset is meant for distribution to the owners. For example, normally this may happen in a small company where suppose this is the computer, this computer on which I am writing right now, okay, and this is a company. So this company says we will give this computer to the owner, Mr. Vinod Kumar Agarwal, the shareholder, okay. So then this will become a non-current asset held for distribution to owner. So it is more like a dividend in kind. So it will be treated like a dividend in kind. What about the further accounting treatment? It is similar to non-current asset held for sale. So let us see the provision governing non-current asset held for distribution to owner, where some asset may be distributed to owner in the form of dividend. But till that time it is distributed, how will you do the accounting? A non-current asset is classified as held for distribution to owner when the entity is committed to distribute the asset to the owner group. Now, what are the conditions you will check to know whether this asset is available for distribution to owner? Asset must be available for immediate distribution in their present condition, and the distribution must be highly probable. So this word sale is substituted by distribution. Second, action to complete the distribution must have been initiated and should be expected to be complete within 1 year from the date of classification. Fourth provision is that action required to complete the distribution should indicate that it is unlikely that significant changes to the distribution will be made or that the distribution will be withdrawn. I am not explaining because what they have done, the sale word is replaced by distribution, and the probability of shareholders' approval if required in the jurisdiction should be considered as a part of the assessment where the distribution is highly probable. Owner means the shareholder. Shareholder, yes. In case of a company, the owner means the one who holds the equity interest. Whosoever is the holder of the equity interest is called owner. Definition of owner we will see in IFRS 10. Okay. Parent company is the owner in case of subsidiary because that is holding the equity interest. This standard is applicable to non-current asset held for sale, non-current asset held for distribution, but this standard is not applicable to non-current asset or a disposal group that is to be abandoned. Not applicable. Why? Because it is not held for sale. It is to be used. Okay. And then finally you are going to leave it, abandon. So therefore the standard says it is not applicable to asset which is to be abandoned. Abandoned means you are not going to sell it. You are just going to use it and then you are going to just leave it. A non-current asset or disposal group that is to be abandoned shall not be classified as held for sale. The disposal group is to be abandoned would however be treated as a discontinued operation if certain conditions are fulfilled. So disposal group to be abandoned can be treated as a discontinued operation if certain conditions are fulfilled. So if you have an operation in Iraq, that means it was generating revenue for you, assets were dedicated to it, but then in Iraq there is a civil war and the company may decide to abandon that operation. So then it will become a discontinued operation, and then disclosures of discontinued operation will become applicable, but it will not be treated as held for sale. The adjustment to carrying amount by way of depreciation, amortization, etc. of such asset will be continued until the asset is abandoned. This line is applicable for held for sale also, held for distribution also. Continue to provide depreciation, continue to provide amortization till the asset is either the date you decide to call it as a held for sale, held for distribution, or abandoned. The entity shall not account for a non-current asset that has been temporarily taken out of use as if it had been abandoned. So temporarily taken out of use is not equal to abandonment. So you may just keep aside some asset for a few days. That is not equal to abandonment. Now we'll come to next theoretical question. What if the sale could not be completed within 1 year? The problem says that the sale must be completed within 1 year from the date of classification. Can you reclassify it as again non-current asset? The answer is no. If the entity remains committed to its plan for sale. So extension of expected selling period beyond 1 year. Now again see the subjectivity is involved. Due to circumstances not within the control of the entity, does not preclude an asset or a disposal group from being classified as held for sale, provided the entity remains committed to its plan for sale. These are the practical challenges. You may be looking for a buyer actively, but you are not getting the buyer. So this is beyond the control of the entity. But entity says we are going to sell it. The moment we get the buyer who is going to purchase it at a reasonable market price. Now come to the accounting part. What will be the measurement principle? The measurement principle for non-current asset held for sale is lower of the two. Its carrying amount and fair value less cost to sell. What about the carrying amount? How will you calculate? You will apply the respective IFRS. Okay. So if it is a property, plant, equipment item, then you will apply till the date of classification IS 16. You will provide depreciation up to the date of reclassification as held for sale. You will also provide impairment loss up to the date of classification as held for sale. So first you do everything that is required under other standard up to the date it is classified as held for sale. Suppose you want to classify it as held for sale on 31st say December. Your year starts on 1st April. So for 9 months you will have to provide depreciation, amortization, and also check for impairment and provide the impairment if required. Then that will become the carrying amount on the date the classification as held for sale is done. So we are going to solve few questions where purposefully in the question the date of classification is after 7 months, 9 months, 11 months. Provide depreciation, amortization up to that date, and then on that day you compute fair value minus cost to sell. Take lower of the two. So if the lower of the two is fair value less cost to sell, it is a loss. You have to charge it to profit and loss. Okay, we'll discuss that. The carrying amount of this asset will be arrived at by applying the respective applicable IFRS immediately before such classification. The implication is that the asset will be subject to depreciation, amortization, impairment up to the date of reclassification. To do everything. Okay, the standard says before you come to me, first to ensure other standards have been complied with up to the date of reclassification as held for sale, and then you come to me. Now dear student, one small question you have to solve. An item of property, plant and equipment that is measured on the cost basis should be measured in accordance with IAS 16. Very good. Entity ABC owns an item of property and it was stated at the following amount in its last financial statement. 31st December 20x1, its cost is 12 lakh, depreciation so far provided 6 lakh, WDV 6 lakh. The asset is depreciated at an annual rate of 10%, means 1,20,000 per annum, 10% of 12 lakh. So these are following SLM, okay. During July 20x2, entity ABC decides to sell the asset, and on 1st August, it meets the condition to be classified as held for sale. 1st August. What is this date? 31st December. Between 31st December and 1st August, count how many months are there? 7 months. So I am going to provide depreciation at the rate of 10% on 1 lakh, on 12 lakh for 7 months. Is it right? And then we'll get the carrying amount. Analyze. But this question is not given fair value. So you will just write a note. At 31st July, entity ABC should ensure that the asset is measured in accordance with IAS 16. The asset is measured in accordance with IAS 16 till 31st July. Then for each line that you write properly, they give half mark to 1 mark. It should be depreciated by a further 70,000. How did you reach this number 70,000? In bracket, if you want to write 7 by 12 into 1,20,000. 1,20,000 is per annum, proportionate depreciation. And then you write down it should be carried at 5,30,000. It should be carried at 5,30,000. How did you reach this magic number? 6 lakh minus 70,000. Before it is measured in accordance with IFRS 5. And one more line. Note, from the date the asset is classified as held for sale, no further depreciation will be charged. No further depreciation will be charged. This way you have to present the answer. Now come to paragraph 10. Non-current asset classified as held for distribution to owner. Same thing will repeat every time. The word sale will be substituted by distribution. An entity shall measure a non-current asset classified as held for distribution to owner at lower of carrying amount and fair value less cost to distribute. Okay. What about newly acquired asset? In some cases, an asset may be newly acquired. Such a non-current asset acquired with an intention to sell. Non-current asset, but acquired with an intention to sell, shall be measured at lower of carrying amount had it not been so classified and fair value less cost to sell. Now this will be a little rare situation, but suppose you have bought a non-current asset and the objective is to sell it. Okay. So you will take lower of the two, which means sometime you might have to recognize a loss immediately. Why? Carrying amount would usually be the cost only or the fair value only, because on the date of buying, fair value is usually the cost. But the second item is fair value less cost to sell. So there is a possibility that in this case you may have to recognize a loss immediately. What about a non-current asset acquired in a business combination? If a non-current asset is acquired in a business combination with the objective of selling it, then it shall be measured at fair value less cost to sell instead of fair value. If you read IFRS 3, what is mentioned in IFRS 3? That the asset acquired in a business combination will be valued at fair value. But if that non-current asset is held for sale, then fair value less cost to sell. Paragraph 13, depreciation or amortization. So this is important. In case if you have classified the asset as held for sale, means now I am going to recover the principal amount or the carrying amount principally by sale. The standard says do not provide depreciation or amortization. From which date? From the date it is classified as held for sale. But suppose it's a disposal group and you have taken interest, you have taken loan and you are paying interest, or you are incurring any other expenses attributable to liabilities, then that will continue to be recognized. Why will you not apply interest accounting for loan taken related to a disposal group? So if you have any loan or such liability, interest paid or any other expense related to liabilities which is forming a part of disposal group shall be recognized. Now the next part is subsequent measurement. Subsequent measurement principle in case of disposal group. For individual asset, you will follow the same rule. Which rule? Carrying amount and fair value less cost to sell. In case of disposal group, there may be asset whose measurement provisions are governed by other specific relevant standard. Okay. So a disposal group, as we discussed, may contain many assets, including some current asset also. So like for example, it may contain property, plant, equipment, but it may have some deferred tax, some employee benefit related asset, some financial asset, some investment property, or biological asset, or contractual right. So what they are saying, these other items will be accounted, that is their valuation measurement will be done as per the specific relevant standard. Do you have any idea which standard deals with deferred tax asset? IS 12. Employee related IS 19. Financial asset 32, IFRS 9 and 7 for disclosure. Investment property carried at fair value, IS. Biological asset 41. Contractual right, so this you apply the relevant standard. Okay. The carrying amount of those assets shall be arrived at by applying the applicable IFRS before remeasurement of fair value less cost to sell in respect of the disposal group. And now there is a small note on cost to sell. When the sale period exceeds 1 year, the component cost to sell shall be measured at present value and any future increase in such present value shall be presented as a finance cost. On one hand, the definition of cost to non-current asset held for sale, they are assuming that sale period will be 1 year. But suppose in some exceptional cases they permit more than 1 year. If it is a huge piece of some asset, maybe it takes time. So keeping that possibility in mind, if it is more than 1 year, then apply the discounting for the cost of sale. Solve one small example. A plant's fair value is 2,50,000. What happened? It is given in the standard example, and its cost of disposal after 2 years is 20,000. But it will be disposed after 2 years. The present value of the cost to sell is 17,500. So on the reporting date, we will account at what value? Fair value less cost to sell will be equal to 2,50,000 minus which figure? 20,000 or 17,500. The answer is 17,500. You will deduct. Write down the answer. Just one word. 232,500. 232,500. Sale of an asset like a plant may take a lot of time. So in this case, you can take 2 years also. Now the next is impairment and reversal of impairment loss. Good news. Refer IAS 36. Is it right? Refer IAS 36. So just quickly revise what is this. Impairment loss is recognized for any initial or subsequent write down of the asset to fair value less cost to sell. One impairment loss will be up to the date of classification as held for sale. After that, if there is a fall in the value, then it is post classifying it as held for sale. When and if a reversal of such impairment were to occur at any later date, the amount of reversal shall be restricted to the cumulative amount of impairment loss. So what is the maximum reversal allowed? Impairment loss already recognized earlier as per the other IAS or as per this IFRS. Okay. So the total amount that you can reverse is the amount of reversal shall be restricted to cumulative amount of impairment loss earlier recognized on the standard in accordance with this IFRS or in accordance with IAS 36. That is the maximum reversal that is allowed. More than that, if you have to reverse, then you have to go to IAS 16 and check whether revaluation is allowed or not. And if revaluation is allowed, then over and above that you can do it subject to revaluation surplus. What happened? Sometimes we may change the decision to, if we change the decision to not show it as held for sale, which will come after 1 or 2 paragraph, then the problem of reversal will arise. Otherwise reversal will not be arising, because every year it is lower of the two, carrying amount, fair value less cost to sell. So previous year carrying amount will become this year carrying amount now. Okay. First we'll solve that big problem, yes or no? Or should we first discuss the theory part? Okay, first you come to paragraph 17 after 2-3 pages. Questions we will take, those 2 big case studies. But for that I need some more discussion. Is it possible? Very interesting situation they have visualized. There is a plan to sell which they have converted into plan to not sell, nahi, to distribute to owner. To distribute to owner. So my measurement principle earlier was carrying amount or fair value less cost to sell. Now my measurement principle is carrying amount or fair value less cost to distribute. Okay. So you will have to move from one classification to another classification. The non-current asset held for sale or is held for distribution to owner shall be reclassified as held for use if it does not meet any of the criteria laid down for classification under held for sale category. At the time of reclassification, the measurement of non-current asset shall be lower of. This is a change to plan, sorry. We'll come to that other situation little later. That means I have decided not to sell or I have decided not to distribute. So on that date, human beings are very typical creature. They keep changing their mind. Now the mind has changed again to not to sell, not to distribute. So then it will be classified at lower of the two. Which lower of the two? Its carrying amount before the asset was classified as held for sale or held for distribution to owner. That means you do the original accounting again. And had you followed the original accounting, today what would have been the carrying amount? Forget that you had in the meantime classified it as held for sale. Okay. Had you not classified it as held for sale, what would have been the carrying amount as per your previous policy? Taking into account any depreciation, amortization, revaluation, in fact, impairment also you can add, that would have been recognized had the asset not been classified as held for sale or held for distribution to owner. So go to flashback, forget this adjustment you had ever done and find out what would have been the balance today. And second is recoverable amount. At the date of subsequent decision not to sell or distribute. If take lower of the two, compare it with your existing book value and the difference will be recognized. Okay. So where will you recognize the difference? Let us read this paragraph. The resulting adjustment should be reflected in profit or loss from continuing operation normally. But if the asset was revalued before classification as held for sale or as a held for distribution to owner, that means it is a revalued asset. In this case, the adjustment shall be treated as revaluation increase or decrease. So for a non-revalued asset earlier, P&L account, revalued asset, revaluation, increase or decrease. Now search for this question below. Question 13 is there. Solve yourself. I'll give you 1 minute to try. 30 seconds plus 30 seconds. 30 seconds read, 30 seconds solve. Please try. One student is saying 49,000. Any other opinion? Lower of the two. 60,000 minus 6 minus 6. Two times 48,000, and recoverable amount is 49. So you will record the asset now at 48,000, but its book value is already 50,000. So what will you do? 2,000 loss. So write down the answer. A small mistake can cost you few marks. If the asset was not classified as held for sale, then the carrying amount would have been then the carrying amount would have been 60,000. 2 times minus 6,000 equal to 48,000. Since the lower of the two, before that I think we should write one more line. The recoverable amount is 49,000. Recoverable amount is rupees 49,000. Now you compare the two, apply the standard. Simple question for 4 or 5 marks. Since the lower of the two is rupees 48,000, the asset would be measured at this value. On 31st March 2012. The asset would be measured at this value on 31st March 2012. Current carrying amount is rupees 50,000. So from 50 you have to move to 48. The current carrying amount is 50,000. Therefore impairment loss rupees 2,000. Where will you recognize the impairment loss? In the SOPL under continuing operations. Under continuing operation, we are going to continue with this asset now. Okay. All of you have noted. Now come to next question number 14 below. The answer is printed, so you will focus on understanding. Okay. S Limited purchased a property for rupees 6 lakh. On 1st April 20x1, the useful life of the property is 15 years. So 6 lakh divided by 15, how much depreciation? 40,000. Okay, let us see whether that is relevant or not. So 40,000 per annum is the depreciation. On 31st March 13, how many years are over? 2 years are over. So which means you have already depreciated it 80,000 rupees. 40,000 into 2 times. Okay. So what is the current carrying amount on 31st March 2003? 6 lakh minus 80,000, 5 lakh 20,000, and the impairment testing provides the estimated recoverable amount at 4 lakh 70,000. This also you do. So further you reduce by 50,000. After providing impairment loss, the carrying amount is 4 lakh 70,000 now. Depreciation and impairment first you provide up to the date of classifying it as held for sale. The fair value less cost to sell was 4 lakh 60,000. So now we have two numbers to compare on the date of reclassification as held for sale. 470 versus 460. Which number we will take? 460. So we are going to again reduce it by 10,000. So this first impairment loss is before classification as held for sale. Second 10,000 reduction is after classifying as HFS, held for sale. On 31st March 14, means one more year has expired. The management changes the plan as property no longer meet the criteria of held for sale. Now, what is the recoverable amount on this date? 5 lakh. Value the property. Question is, value the property at the end of 2003. So 2003 we have decided 4,60,000. Lower of the two. Carrying amount and fair value less cost to sell. And 2004 would be lower of recoverable amount, and the carrying amount had you not treated it as held for sale. So till last year my carrying amount was 4,70,000 before reclassifying. So I would have provided depreciation for one more year on this asset. Had I not reclassified in HFS category, I would have provided depreciation for one more year. How much depreciation I would have provided in the third year? Now the carrying amount is 4,70,000. Remaining life is 13 years, 15 minus 2. To take 4,70,000 divided by 13, 36,154. So your carrying amount would have been 4,70,000 minus 36,154, which is 4,33,846. 433,846 or 5 lakh, whichever is lower, 433,846. But my carrying amount is 4,60,000. Again I will write off the difference. Okay. So see how to present the answer. First we will find out the carrying amount on the date of reclassification. Cost 6 lakh, depreciation for 2 year 80,000, balance before impairment 5,20,000, less impairment loss 50,000. So carrying amount after impairment loss 470. So at the end of year 2, this is my carrying amount. Then calculation of value of property on initial classification as held for sale, lower of the two. Carrying amount 470, fair value less cost to sell 460. So the answer is the asset will be recorded at 4,60,000, and 10,000 rupees you have to further write off. Then come to 31st March 20 X4. Carrying amount before classification as held for sale was 4,70,000 minus depreciation for 1 year 36,154. So revised carrying amount if the asset had not been classified as held for sale 433,846, but the recoverable amount is 5 lakh. So I will take lower of the two. So the answer is property will be valued at 433,846. And the difference between your 4,60,000 and 433,846 will be charged to profit or loss. That is 26,154. Understood? You will be able to handle such questions in the exam. Okay. Now come to this question which is printed earlier. This is question number 12, I think. 12 number. Solve in the book, it will require a lot of space. E Limited plans to dispose of a group of asset and liability. So this is a problem on disposal group, which satisfy held for recognition criteria as per IFRS 5. Given below are the detail of these assets and liabilities. So this entire thing, where it has gone? From here to here, it is one asset group only. Is it right? To keep you busy, I have not given the figure in your notes. Write down. Goodwill 80, building 100, PPE 1400, inventory 500, advance to supplier 20, financial asset 1200, total asset 3300, deferred tax liability 30, payable to supplier 20, 10% loan 500, defined benefit obligation 50, total asset 600, and the book value is 2700 net asset. And below the table, fair value less cost to sell of this entire disposal group is 2200. How should the entity recognize various assets and liabilities of the disposal group on the classification of held for sale as per IFRS 5? Now, what is the decrease in the value? 2700 is the carrying amount of this group. Fair value is 2200. For many items, this standard will not be applicable. The standard will not be applicable for non-current assets. Not applicable for current assets. It's applicable only for non-current asset. Okay. So inventory, advance to supplier, financial asset will appear as it is. All these other items will fall under other standards. Will appear as it is. So where will you allocate that 500? First we will allocate to goodwill 80, and remaining will be allocated in the ratio of 100 and 1400 over building and property, plant and equipment. Okay. So first you write a note, or without writing a note you want to solve. Note briefly. This much answer you have to write in that space. E Limited would recognize 500 million, figures in million, as impairment loss. As impairment loss on classification of the disposal group. On classification of the disposal group. How this 500 has come, you have understood? Difference between net asset and fair value less cost to sell. Then the impairment loss is allocated to non-current asset. This standard is applicable to non-current asset. Okay. To which measurement requirement of IFRS 5 is applicable? To which measurement requirement of IFRS 5 is applicable? The loss is first allocated to goodwill. The loss is first allocated to goodwill and then to building and PPE, and then to building and PPE as per IS 36. As per IS 36. Okay, write only this much. Now draw this table. 4 columns draw. Or you want to solve in the question only? Either way. You can add 2 more columns in your question only. 2 small columns, and you don't have to copy the whole thing again. Is it right? So I am not going to allocate to current asset any item or this liabilities item. So only I will allocate to goodwill 80 and to building and property. Just try on your calculator what is the remaining loss. 500 minus 80, 420. Is it right? 100 upon 1500 into 420. Round off. Is it 28? 100 upon 1500 into 420, 28. 1400 upon 1500 into 420, 392. So therefore the carrying amount after allocation of impairment loss, goodwill will become 0, building will be 72, and PPE will be 1008. Done? Done. Okay, now you come to paragraph 18 first. 18, which is not appearing on the screen. But first we'll read from the book only. Para 18, very rare possibility, but the standard setter considers whatever maximum they can visualize. In your note, reclassification of an asset or disposal group directly from being held for sale, so it was earlier held for sale, to held for distribution to owners or vice versa. Possible or impossible? Possible. Even though it is rare, at least in my limited understanding of this business world, I have never seen this transaction. If you have seen, please inform me. Seen? No. But suppose some companies want to try this paragraph, okay? The auditor should know, like people like you. If an entity reclassifies an asset directly from being held for sale to being held for distribution to owner, or directly from held for distribution to owner to held for sale, then the change in classification is considered. Change in classification is considered as a continuation of the original plan of disposal. So are you going to make major change? No. The entity shall apply the classification, presentation and measurement requirement in this IFRS that are applicable to the new method of disposal. So if you have changed from HFS to held for distribution to owner, then whatever principles are required for this category, do that. So maybe your value may change slightly. Held for sale is valued at carrying amount and fair value less cost to sell. Less cost to sell. It is fair value less cost to distribute. So there may be difference between these two numbers. Accordingly, you change the classification. Even the presentation in the financial statement would change. Okay. Now next paragraph. (19) number. Let me see whether I have written that or not on the screen. If an entity decides, yes, para 19 on the screen, if an entity decides not to dispose of one or more item within a disposal group, This is another peculiar situation. This is my disposal group consisting of factory, building, which may include plant and machinery and other items. They may decide now not to dispose plant and machinery. Okay. Entity decide not to dispose one or more item within a disposal group. So now this you will have to remove. It is no longer held for sale now. So for this you have to apply the principle. What will you do if you are not going to hold it for sale? And then you apply the IFRS 5 for the remaining group if it fulfills the definition of held for sale, etc. Is it right? So the reclassification principle will be first applied for the asset, for which the decision to dispose has been reversed. Remove it. And what will be the value of this asset? Lower of the two. Which lower of the two? Carrying amount, had you not classified it as held for sale, or recoverable amount. Now this we have removed. So what is remaining? Remaining assets are there. Assets and liabilities comprising the new disposal group again will be subject to classification criteria, and measurement principle will be applied to the remaining group accordingly. So again you have to check whether this group fits into the definition of non-current asset held for sale. If yes, again you apply the measurement principle for the remaining group. Now the next few lines are pending. Presentation and disclosure requirements. Three important requirements relating to presentation of item classified as non-current asset held for sale. Principle number 1. Assets so classified shall be presently separated from other asset. So your financial statement should very clearly differentiate such asset from other asset. Liability forming part of a disposal group will be presented separately from other liabilities. Okay. And third principle is that these assets and liabilities shall not be netted off. Even though they belong to a disposal group, they will be presented separately on the asset and liability side and disclosed separately from other assets and liabilities. Then the major classes of assets and liabilities classified as held for sale, major class, this is a repetition of this point number 2 only, shall be separately disclosed either in the statement of financial position or in the notes. The major classes of assets and liabilities as held for sale shall be separately disclosed either in SOFP or in the notes. An entity shall present separately any cumulative income or expense recognized in OCI relating to a non-current asset or disposal group classified as held for sale. Solve one question number 15. Only tell me what are you going to do with this asset? Which standard will you apply? How would this asset be shown in SOFP? A property given on rent, machinery used for production, car not in use, for which prospective buyer is being looked for. When a property worth rupees 5 lakh with furniture worth rupees 1 lakh and loan taken 3 lakh, taken specifically for the property, advertisement have been issued about intention to sell the property with the loan thereof. First answer. Anybody? Property given on rental, IS 40. Machinery used for production, IS 16. Car not in use for which prospective buyer is being looked into. Non-current asset held for sale, IFRS 5, and this one is a disposal group held for sale. IFRS 5, write down. For the first item, it will be shown as investment property. The question is how this will appear in SOFP. So this will be appearing as investment property. The second one will appear as non-current asset, PPE. The third one will appear as non-current asset held for sale. Disposal group held for sale. Disposal group held for sale. Now we'll continue tomorrow.